Hello, everybody. So let me talk to you about a winner today, and it's rare enough to be celebrated. It's LifeMD. It's up 21% today. It is stupid cheap, and I think it is barely up. Remember, 3 weeks ago, this stock was trading at $8. We are barely reclaiming the $5 because this stock has been sold off in this risk-off environment, and it has been sold off despite being the cheapest, the second cheapest. But it's kind of like the cheapest stock in my portfolio that you can get on a mainstream broker. Out of the almost 200 stocks that I analyzed, this is the second cheapest, but the bigger cap, right? The bigger market cap, cheapest. So anyways, let's go. They reported their earnings today. Revenue grew 43% year over year. EBITDA leverage is on. The EBITDA grew 78% year over year. EBITDA is growing faster than revenue, which means that we have operating leverage. They are still reporting a GAAP net loss, which I guess is why the stock is only up 21%. This sets up for really good headlines in the quarter ahead. Perhaps the next quarter they will report their first EBITDA gain. Typically, the market tends to love that. Moving on, they are up 27% in subscribers headcount. That means because the number of subscribers grows slightly lower than the revenue. Revenue is up 43%, subscribers up 27%. That means that they are gaining more customers who are spending more on the platform, not less. And that's what you want to see. More people signing up, spending more. The average spend needs to go up, and the number of people making that spend needs to go up. This is how businesses display exponential revenue growth, and they are very excited about Medicare coming on April 1st to the platform. Why are they excited about Medicare? Because Medicare could cover for some GLP-1s. Although weight loss may not be the reason why someone gets a GLP-1, there may be a lot of people who are 65 plus, who get Medicare, and who qualify to GLP-1s via overdiagnosis like diabetes or pre-diabetic diagnosis. This is something that their medical doctors can give to the patients through their telehealth offer. And if they find that someone is pre-diabetic, they may prescribe a GLP-1, and you may get Medicare to pay for it. Remember, they have a branded strategy. They sell the branded GLPs. Sure, they just started a small offer of a compounded semaglutide, but that's coming off in May anyways, and that was never a meaningful part of the business. Neither will it be a meaningful part of the business. This is a business that is selling the branded GLP-1s and that is trying to get your pharmacy benefits to pay for those GLP-1, and the benefits of the folks of Medicare will likely help cover some of the cost of these GLP-1s. Let's look at the past growth and the forecasted growth. So like I said, the past growth, this is a business that grew revenue, so 39% if you look at it, but 43% year over year if you look at Q4. So let's call it roughly 40% if you look at full year to full year, 40% year over year revenue growth between 24 and 2023. These are the actual numbers. And when it comes to their estimate, when it comes to their guidance, they are guiding 270 million revenue forecast for 2025. Keep in mind, this is a business whose market cap is 210 million. No debt, same amount of debt as cash. So that's no factor. EV is 210 million. This business is going to make 270 million worth of revenue in 2025. Something is not adding up. The price to sales is way too low. What I very much love, and this was a surprise to me, this is why I said this was such a great quarter, this was a surprise to me, WorkSimpli, which is their kind of mini competitor to DocuSign, is the way I call it, teeny tiny competitor, nowhere near the size of DocuSign, of course. But WorkSimpli is growing again, and this is very surprising. I did not expect this. WorkSimpli is growing again. I'll get to the guidance, but they grew this quarter, they grew the prior quarter, and what is absolutely amazing about WorkSimpli, you may be interested to learn that they and it started as PDF Simply, which is just a PDF merge tool. They invested only $250,000 in that company. So they grew that company from a $250 million investment to, in 2023, a company that was making $16 million in EBITDA. That is very impressive that they were just able to turn that up in-house, and it's a side business for them. It's a business that is forecast to make $60 million in revenue just for a side business. This is a pleasant surprise to see that WorkSimpli is growing again, because when you see between 2023 and 2024, WorkSimpli did $54 million in sales and $54 million in sales. So WorkSimpli had not grown prior. It is now growing again, and because that software business that they own is growing again, that means they're going to be able to probably sell it for more money than I was anticipating. This is a good news. Operating leverage is kicking in. They are now predicting $20 million in adjusted EBITDA for the full year 2025. That is their forecast. You can look at the specifics of their forecast for each business. I consider all of this to be heavily sandbagged, especially the telehealth revenue predicted to grow in the higher range at 34%. Come on, we're gonna move to such a low revenue growth compared to prior quarters, where, as a reminder, telehealth revenue was up 60% in the prior quarter. So I think this is heavily sandbagged. Anyways, that is not the point. The gross margin is up every year. It is up again throughout 2024. The gross margin has been going only one direction, and it is up. And this is despite the GLP-1 offering. Why? Because they have a branded GLP-1 offering. If you follow HIMSS, you know HIMSS gross margin went down a little bit because of a GLP-1. Not at LifeMD. Ad spend is down. Ad spend in 24 is down compared to 23. It's now at 43% of revenue is the ad spend. This is going in the right direction. Do you remember how much FUD HIMSS had to go through, especially in 2023, regarding to their ad spend and the market not being happy about them spending money on ads? I just want to do a quick word on RexMD, another ingrown business, a low budget HIMSS competitor, a tiny HIMSS competitor that was able to achieve $60 million in gross margin, $75 million in revenue in 2023, 500,000 patients. Again, this is RexMD. This is their side business, and they're leveraging the LifeMD platform on the back end to power RexMD, i.e. the doctors who work for LifeMD also see patients on the RexMD side, right? RexMD, king in Latin is Rex. It's focused only on men's health. They sell a lot of ED drugs on there. It's the main marketing, RexMD. It's red. It's a manly marketing. Go on the website. I suggest you go look at it and you know, sure, it's not nearly going to be as good as HIMSS, not even as good as Row, but what if they even end up being the third player? Well, what does that mean? $75 million in revenue, 500,000 patients. That's what it means. And they sell GLP-1s via RexMD too. Some people use HIMSS, some people use Row, some men use RexMD, and they have their own marketing, their own marketing codes, advertising, etc. This is very surprising. A shoestring budget. It was launched on a shoestring budget in late 2019. What does that mean? Does that mean $250,000 like WorkSimpli? Does that mean $500,000? Is this all they spent? This is a business that has been able to grow in-house, and that is very impressive. Going back to the valuation, as you know, on this channel, I'm big on the valuation metric that I called enterprise value over gross profit over revenue growth. What do I do with this metric? I answer, how much am I paying for that growth? How much am I paying for that growth? How expensive is that growth? LifeMD, after today's jump, the stock price right now is trading at $5.12. It is still trading under a 0.05 at a 0.04. The rule of 40, you'll forgive me for putting it in green here. It's 40, it's 39. It's essentially very, very essential. Have the rule of 40. You now have a business that is still earning, I checked, it's still earning a 12% EBITDA margin. I recomputed that myself. It is the margin. It hasn't changed. Same for the gross margin, but we're predicting the total business to only grow at 27%. The question here is, do you believe that? Do you actually believe that? And moving on to supposing they sell WorkSimpli, which they should, because if they sell WorkSimpli, then that LifeMD can be looked at as a pure play telehealth business. If they were to sell WorkSimpli, well, what is it worth, right? That's the big question. So because WorkSimpli is now growing at 15% sales, because it's now a growth business, I'm assuming 10x EBITDA, so 10x 12 million, that's the 2025 EBITDA they're expected to do. I'm assuming that's a fair valuation. So 10 times 12 million, 120 million is what I'm assuming they're selling WorkSimpli for. How about that? How about I take 120 million from 210 million? That's a business of LifeMD that I end up valuing it at 90 million, for revenue now of 140 million. Revenue growth 34% because I'm taking just the telehealth side of the business. Gross margin and EBITDA margin out of the same. What do I get if I assume they sell WorkSimpli? I get an enterprise value over gross profit, over revenue growth for LifeMD of a 0.02 even. And if the stock is not up more tomorrow morning, if it's like say only up 18 or 17%, then you're under a 0.02. Rule of 40 would be a 46. The telehealth business is more profitable than WorkSimpli. And again, it's all about that growth rate. My spreadsheet is so growth rate dependent. Do you think it's going to be 34%? When the telehealth revenue was actually up 60%. Can the business drop from 60% Q4 to Q4 of last year to 34%, almost half? Can you almost halve the revenue? I don't believe that. I think that is sandbagged. Let me conclude by talking about insider ownership. So the two leaders of the company, they own 25% of the company. So that's a significant level of insider ownership. It's actually about as high as I've seen it before for companies. That's point number one. Point number two, I know many of my viewers care about shares outstanding. So I've looked at the detail of share count, and you'll forgive me for not having the December data, but roughly the shares outstanding over 21 months, they're up 35%. So if you annualize that, that's roughly a 20% growth in the share outstandings per year for a business who, as a whole, was going at 43% revenue. And if you just look at telehealth, which, let's face it, is what we're interested in, was growing at 60% revenue. And so 60% to 43% versus 20% sales growth, shares growth, I find that acceptable, more than acceptable. I even find it desirable for a business this size because, of course, when you pay your people with shares, what happens? You preserve cash, and it is more tax efficient, and it reduces risk because you've not used that scarce cash to pay your managers. You've used shares that you've printed, right? This is akin to printing your own money and giving it to your CEO, to your managers, so you don't have to actually give them cash. It's perfectly fine to me, but I know some people will eliminate a stock as soon as they see any increase in share count. So if that's you, obviously LifeMD wouldn't be a stock for you. In conclusion, I'm very pleased. I'm very happy with what I see. I can't wait for Medicare to be introduced onto the LifeMD platform and for 65 plus folks to get GLP-1s, branded ones, via LifeMD and via their offering. And I think this is a lot of bullishness coming from this company. This mini HIMSS, still the mini HIMSS, always gonna call it the mini HIMSS. I'm very happy to see the stock doing well. Anyways, this was not financial advice, not investment advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.